All right, earnings season. You know what it's like, right? It's this quarterly flood of numbers, press releases, and let's be honest, a ton of jargon. But if you look closely, underneath all that noise, there are these really powerful signals about where the economy is really headed. So today, that's what we're going to do. We're cutting through all the static to bring you the 5 biggest, most important trends that define the first quarter of 2025. So here's the game plan. We're going to kick things off with the incredible AI gold rush and see how it's bumping up against the new reality of global trade. Then, we'll dive into how those two massive forces are creating this split-screen economy for all of us, for consumers. From there, we'll zoom right into a high-stakes battle raging in healthcare, before wrapping up with the playbook corporations are using to, well, survive in this pretty complicated world. Okay, let's dive right in. Our first trend. It's less of a trend and more like a rocket launch. I'm talking about the race to build the actual, physical foundation of the AI revolution.
And honestly, there's no better way to capture the sheer energy of this moment than this quote from NVIDIA CEO Jensen Huang. The demand for AI isn't just growing, it's accelerating. It's hitting a turbocharge. And that is forcing the biggest companies in the world to spend, and spend in a huge way.
And when I say spend big, the scale is just staggering. Just look at this number. $75 billion. That is Google's planned capital expenditure for this year. For 1 year. It's a colossal all-in bet on servers and data centers, all to power their AI ambitions.
Well, that kind of spending creates this massive ripple effect, right? When a giant like Google opens its wallet, a shockwave just blasts through the entire supply chain. And you can see it right here. Look at a company like Broadcom. Their revenue just surged 25% year over year. And it's pretty much all fueled by this insatiable demand for AI components.
And this is not just an isolated thing. This is a coordinated, sector-wide arms race. You've got Oracle building these absolutely massive GPU clusters. You've got Cisco blowing past its AI order targets way ahead of schedule. Then there's TSMC cranking up chip production because demand is so strong. And Meta? They're already seeing their AI tools used by nearly 1 billion people. Everyone is building, buying, and deploying at a furious pace.
But while the digital world of AI feels kind of boundless, the physical world is actually seeing new walls go up. And that brings us to our second big trend, this challenging new reality of global trade.
This quote here from the CEO of medical device giant Abbott, it's just so telling. The entire mindset has shifted. Companies aren't looking at tariffs as some temporary political thing anymore. Nope. They see them as a permanent feature of the business landscape that they have to manage for the long haul. And this isn't just one industry's problem. This concern is absolutely everywhere. You can see it across all these different sectors. You've got JP Morgan noting its clients are shifting to a much shorter-term focus. GE Aerospace is building more conservatism into its financial guidance. Cisco is actively modeling how tariffs are going to impact them. This is a top-of-mind issue for basically everyone.
So the crucial point, the big takeaway here is this. Companies are fundamentally changing how they operate. You hear it from Eli Lilly's leadership, who said they decided years ago to move away from just pure efficiency and start building for resilience. It's not just about finding the lowest cost anymore. Now it's about security. It's about redundancy. And just like Abbott's CEO said, it's about getting your manufacturing as close as you possibly can to your customers.
Okay, so these massive global forces, all this AI innovation on one side, all this trade friction on the other, they're having a very real impact on household budgets. And that leads us straight to our third trend, a stark and growing divide in how we as consumers are behaving.
I mean, you really can't get a clearer snapshot of the U.S. economy than this statement from the CEO of McDonald's. It's not one story out there, it's two. High-income folks are still spending, but low-income consumers, they're pulling back sharply. And, as he pointed out, that pressure's now starting to creep up into middle-income families too.
And you can see this split so clearly in the data. On one side, you have Bank of America reporting that the account balances for their high-income clients are up a healthy 5%. But then on the other side, you hear executives from companies like McDonald's, all the way to PPG, talking about how low and middle-income families are really getting weighed down by the cumulative hit of inflation. So let's drill down into one of the most dynamic sectors right now,
healthcare. Because this is where all these forces, innovation, global supply chains, consumer costs, are all colliding in a huge battle for a multi-billion-dollar market.
So the war for the obesity drug market is really playing out in 3 acts. Act 1, companies like Eli Lilly and Novo Nordisk create these absolute breakthrough medications. Act 2, they launch an all-out war for market share, for doctors, for patients. But Act 3, that's the trickiest. That's where they have to face the powerful gatekeepers, the pharmacy benefit managers, or PBMs, who ultimately decide which drugs get covered.
You can just feel the tension in this quote from Lilly's CEO. So a major PBM decided to exclusively cover their competitor's drug, and he's basically questioning a decision that limits choices for patients and for doctors. It's a really high-stakes chess match with billions and billions of dollars on the line.
And this number right here, this shows you just how incredibly high those stakes are. This is the year-over-year sales growth in Danish kroners for Novo Nordisk's obesity care division. 67%. That is an explosive, category-defining level of growth, and it explains exactly why the fight for every single prescription is so intense.
Okay, so we've seen a technology boom, rising trade walls, a divided consumer, and just fierce industry competition. So how are corporate leaders actually responding to all this? Well, that brings us to our final trend, the modern corporate survival playbook.
In this kind of environment, companies are basically spreading their bets. On one hand, you see massive share buybacks from names like Walmart and Exxon to get cash back to shareholders. You see dividend hikes from Oracle and Chevron. But at the same time, you see these huge investments in the future, like AbbVie's R&D spend and Google's CapEx, right alongside a super sharp focus on efficiency and cost controls at companies like SAP.
So the crucial point is this. When the big picture, the macro environment, is this uncertain, you have to focus inward. You double down on the operational efficiencies you can actually control. You invest in the core innovations that are going to secure your future, and you reward the shareholders who are sticking with you for the ride. It's a really pragmatic, resilient strategy for some very turbulent times.
And all of this leaves us with this final, really critical question. We are watching these powerful, often contradictory forces pull the global economy in completely different directions. You've got the boundless, deflationary promise of AI on one side and the constrained, inflationary pressure of trade friction on the other. How these two forces balance out, how they resolve themselves, that is going to be the story that defines our economy for years to come.
All right, let's talk about the first half of 2025. It was supposed to go one way, but as we just saw from corporate earnings, the real story is a whole lot more interesting. Today, we're digging into the numbers to see what's really going on.
So remember back after the first quarter, everyone had their predictions locked in. But now that Q2 earnings are out, we can finally see what actually happened. Which trends caught fire, which ones kind of fizzled out, and what new challenges are popping up. Let's get into it.
Okay, here's how we're going to break this all down. We'll start with the AI spending spree. Then we'll look at the consumer, which is a real mixed bag. After that, a total game changer in healthcare, and then the one big question on every CEO's mind, tariffs. And finally, we'll put it all together to see what the second half of the year might look like.
All right, first up, the biggest story out there, AI. If Q1 was the warm-up, Q2 confirmed it. This is a full-blown spending arms race.
So Google just comes out and drops this number that made everyone's jaw hit the floor. $75 billion in capital spending for the year. Just to give you some context, that is a staggering amount of money, and almost all of it is going straight into the technical infrastructure, the servers, the data centers that powers this AI revolution.
And you know, it's not just Google. Microsoft is right there with them, spending over $30 billion on their own AI infrastructure in just one quarter. They're calling it a response to strong demand signals, which is really just corporate speak for, we literally can't build this stuff fast enough.
And all that spending creates a huge bottleneck on the supply side. This quote from the CEO of TSMC, the company that makes the most advanced chips in the world, says it all. They can't keep up. Demand is so high that not only is their newest N3 chip capacity totally booked for years, but even the last generation, N5, is still incredibly tight. The demand is just absolutely off the charts.
And here's the kicker. This isn't just the tech giants buying up all the hardware anymore. Check out these numbers from Cisco. Their orders for AI gear from regular, big companies have blown past $1 billion for the year. This is a huge shift we saw in Q2. It means we're past the experiment phase.
Real businesses are now building serious AI capabilities.
So, while the AI story is one of just pure acceleration, the story for the consumer, well, it's a lot more complicated. If Q1 hinted at a split, Q2's earnings reports really drew a sharp line in the sand. We've got clear winners and losers here.
I mean, just look at this contrast. On one side, you've got a value-focused place like Walmart, and their global e-commerce just exploded by 25%. People are clearly hunting for deals and convenience. But on the flip side, luxury brands like L'Oreal actually saw sales shrink in key markets like North Asia. It tells you that a lot of discretionary spending is really getting squeezed.
And you can actually see this same pattern playing out in China's banking sector. This data from ICBC, which is one of the world's biggest banks, shows a really clear shift. They're lending less to individuals and more to corporations. It kind of hints at a bigger economic strategy, one focused on building up businesses over boosting personal spending right now.
All right, now for a sector with a much, much clearer trend. If there was one story from Q1 that just went into overdrive in Q2, it's this one, the GLP-1 drug juggernaut. We're talking about a class of drugs that are just completely reshaping the entire pharmaceutical landscape.
The numbers here are just wild. Look at Novo Nordisk. Their overall obesity care sales shot up 47% in a year. And check out the shift. Sales of their new drug, Wegovy, jumped 64%, while their older drug just plummeted. The entire market is sprinting towards the newest, most effective treatments at an incredible speed.
And it's not a one-company show. Not at all. Their main rival, Eli Lilly, is riding the exact same wave. A 38% jump in revenue year over year. For a massive company like that, that kind of growth is it's almost unheard of. And it's all because of their GLP-1 drugs. This isn't just a hit product, it's a whole new paradigm for the industry.
Okay, but there's this one big cloud hanging over all these other trends. It's something that just kept coming up over and over again on earnings calls. If it was a small worry in Q1, by mid-year it became the #1 source of anxiety for pretty much everyone. Tariffs. This quote from Amazon's leadership really sums up what we heard across the board. There's just this profound uncertainty. Nobody knows what future trade policy is going to look like, which makes it incredibly difficult to plan anything, from inventory to pricing. Then you have companies like L'Oreal, who are taking a different approach. They aren't waiting around. They're convinced the impact is coming and it's going to get worse. So their whole strategy is about figuring out how to absorb those costs themselves. They're basically bracing for a financial hit.
And for a company like the drug maker AbbVie, this is a really critical point. For them, just hiking up prices to pass the costs on to customers, they're saying that's just not an option. It's not viable. So that forces them to find the money somewhere else, likely by squeezing their own operations.
So what happens when you put all this together? You've got these incredibly powerful but kind of conflicting forces at work. What does that tell us about the second half of the year? Well, a few key things really stand out. So here it is, the big picture after the first 6 months. You've got this AI gold rush, with tech spending billions, limited only by the physical supply of chips. At the same time, the average consumer is getting more cautious, choosing value over luxury. And then you have this massive tariff wildcard just waiting to disrupt supply chains and drive up costs for everybody.
And all that leaves us with one final, huge question as we look ahead. You've got two massive, opposing forces, a powerful technological tailwind from AI pushing everything forward, and a significant economic headwind from tariffs threatening to slow everything down. So which one is going to win? Will the AI boom be strong enough to power through the drag? That is the story to watch for the rest of 2025.